Hello. Now we will study Ind AS 1 presentation of financial statements. See, Ind AS 1. Ind AS 1, it's like AS 1. AS 1 was disclosures of accounting policies, disclosure and presentation of accounting policies. Similarly, in Ind AS 1, we'll study presentation of Ind AS as per FS. See, first it is Ind AS 1 applies to separate FS, CFS, SFS, and it does not apply to interim financial statements. Keep in mind, Ind AS does not apply to interim financial statements. There are two notes. If NPO is Section 8 companies, apply this standard, they may need to amend the description used for particular lines in the items of financial statements. If NPOs are using Ind AS, then they need to amend some lines in the financial statements. Okay. In case of conflict between Companies Act and Ind AS, follow Companies Act, and in case of conflict between Schedule 3 and in AS, then go for Ind AS. See, if there is conflict between Companies Act and Ind AS, go for Companies Act. And if there is Ind AS and what? Schedule 3, go for Ind AS. See. Financial statements. What does financial statement comprises of? Give me in comments. See, first is balance sheet, P&L, changes in equity, cash flow, notes to accounts, comparative information. Then balance sheet in the beginning of means that is first it's given. A balance sheet at the beginning of preceding period is to be prepared only when an entity applies an accounting policy retrospectively or makes a retrospective restatement of items in its financial statements or when it reclassifies items in its financial statements. Again, a balance sheet as at the beginning of the preceding period is to be prepared only when an entity applies an accounting policy retrospectively or makes a retrospective statement of financial of items of in its financial statements or when it reclassifies item in its financial statements. An entity is not required to present the related notes to the opening balance sheet as at the beginning of the preceding period. Balance sheet. Balance sheet to be prepared as per Schedule 3 of Companies Act. Okay. An entity shall present current and non-current assets and current and non-current liability as separate bifurcation. Okay. First, we'll go for current assets. Classify an asset as current only when four conditions are met. What are the four conditions? It is expected to be realized or intended to be sold or consumed in normal operating cycle. Okay. Now we'll once just read what is operating cycle. Operating cycle is the time between the acquisition of asset for processing and the realization in cash or cash equivalents. So if I took a machine and after selling the products using the machine for manufacturing and the sale which I did by selling the products and the cash inflow I got, that is whole the operating cycle from the day of purchasing the machine till I get my cash inflow. When the entity's operating cycle is not clearly identified, then it is assumed to be of 12 months. See, what are the four conditions? It is expected to be realized or intended to be sold or consumed in normal operating cycle, that is 12 months, or it is expected to be realized in 12 months after the reporting period. Okay, so after 31st March till 12 months, it is expected to be realized. It is held for trading in ordinary course of business. It is cash and cash equivalents unless it is restricted of being exchanged or used for settlement for at least 12 months from reporting date. Okay. Non-current assets. Non-current assets are like more than 12 months. See, now I'm just giving a reading. A breach of long-term loan arrangement. Okay, if there is a breach of non-current loan arrangement before balance sheet date, grace period to rectify the breach is provided by the lender. There are two cases. Case A, grace period is less than 12 months from the end of the reporting period. Classify the loan as current liability. If the grace period is more than 12 months from the end of the reporting period, classify the loan as non-current liability. Okay. The date company gets the compliance date extended before the breach, then such loan will retain its original classification. That is, it will be classified as non-current even if such extended period is less than 12 months from the end of the reporting period.